Hi, this is Peter with Quantum Edge AI, and we're going to be discussing the covered stock trade. So there's really two ways to cover stock. You can be long the put or short the call. I always prefer short the call versus long the put, mainly because you're going to be generating income with one and you're going to be losing income with the other. You're going to be paying for this. This is a net debit. This is a net credit. So first we'll discuss the short contract, the short call. And using Quantum Edge AI's forecast, you can determine where you want to place your option. Now, if we look at this is pretty delta neutral according to Quantum Edge AI. And you can place, depending upon how you feel about the stock also. Is this a is this a long position for you? Is this a longer term position for you? Is this a shorter term position for you? Um, and that is really the question you have to ask yourself is when you're locating a strike price, um, what is your sentiment about price? You still are going to hedge this position, but the question is, how are you going to hedge this position? Are you going to sell the in the money call? Are you going to sell the at the money call? Are you going to sell the out of money call? After this movement upward, that's really the question. You could have been trading this too. You could have said, okay, well, this gap movement upward, I'm long this stock. I'm up 10, 11, 12% throughout this place, this location and price. Maybe I want to hedge this position. I can be selling the in the money call here and closing it when it moves further down, or I can hold it through expiration and net that income, or I can also be long the put. You can long this put, say for example, at this location, 127. So price is at 133. You bought the put here, you hedged it, it came down. In a perfect world, this is what would happen. But hindsight is 2020, and this isn't always a it isn't always going to revert, right? But you do want to hedge this position. Say you're a long stock and you are a weekly to monthly trader and you want to be hedging this position. You netted that 10, 11, 12% gain, but you don't want to sell your stock, but you want to trade and roll these in the money contracts, in the money out of the money calls to generate income across multiple tickers. Um, you would do that by selling the in the money. In this case, this is the 132. We can sell the 130 or the 131, which is closest to the low forecast. And when it reaches this point, if it does reach this point, you're closing this position. You're closing this position in the event that you have this movement lower. Now, in the event that you have the movement higher, it is what it is. You're still delta positive. Your P&L is positive. Your theta decay is positive. Um, so you'd be netting the differential between 135.86. Um, so basically, where the difference between 131 and where price is currently. What was your debit? So you're going to be netting this premium and whatever you give the stock up for. Now, you can sell this at multiple locations. You can sell this at the 139, the 140. You can be more delta positive, and your total gain here is 531 in the event that price moves through that high forecast. You can be at the money and cut your delta in half and still be generating theta decay. This is probably the most uh, beneficial way to do it, I would say, is selling the at the money. You have the benefit of netting this $280. Um, if it does reach the high forecast, you are um, you still have made 4% on the way up here. Uh, Not 4% of the total, but half of that 4%. Um, and you can open and close this position as you see fit throughout the channel. So say for example you were at the open shorted that position, and now you're going to close it because it it moved down a couple, half a percent. You close this position at a net gain of maybe 20 or $30, and then you wait for another ramp up, and then you open it up again. So this is what the reason for quantum edge AI is, to place your strikes in a location that is optimal, um, or your profit targets. But in this case, we're discussing the covered stock. Now, you could also say, well, you know what? I think this thing is going to continue ramping up. The high forecast is there, but you know what? I believe that it's going to continue through. Now, you can also say, well, if that's the case, I'm going to buy a put. I'm going to buy a put at this at the money, and I'm going to do the opposite. Now, this looks good on paper, but the the reality is that this is probably going to lose money. I mean, you have a net debit of $280. You you made this through here. You made $700 on 100 shares through this differential, and now you're going to pay to hedge. I personally don't like that idea. I'm not a big fan of that. I've done it too many times before in the past, and just it feels like you're being robbed, because even in the event that it does move down here, you're still losing, this differential here, this net debit. So I would not recommend uh, long puts in the front week. It just doesn't make a ton of sense in terms of hedging. But you can do it. What I like is selling calls against a position. And then what we can do is, say, for example, this does happen. You sold the 136, price continues to move up, your theta decay is solid, you made a couple bucks on the way up here. Now, say for example it is above 136. Okay, well it's in the money at expiration. What you can do is roll this contract based upon the new forecast and roll this into a new trade. It can be high forecast, it can be close forecast, it can be low forecast. And you can roll this and generate more theta. What you want is to be continuously generating theta. You do not want to be long that put and giving money back and paying for these positions. It doesn't make a ton of sense unless you have some real impetus to, some real reason for longing that contract. And uh, I just wouldn't advise it in terms of I'm not advising anything. This is not investment advice. This is my personal take on current position. But I would say you would rather be selling these calls, generating this $300 in income, and then taking the long term, the downside risk for the position. If you want, you can be setting up another way too, which is, maybe you do want to say, okay, well, I purchased in this location here. I made this nice 15% gain. But and during this flattening out area, you know what? I do want to hedge with a long put, but I want to be hedging out a lot further. Say for example, it does come back to this area. I'll pay for that and I'll buy the long out of the money put. I'm still going to be delta long. I'm still going to be theta positive, but now my risk is now finite. Um, Finite below, um, you know, way below here. This is obviously something that if you believe this is a possibility, you probably, wouldn't be out of the position entirely. But this is a stock market. Uh, Anything's possible. It could be, gapping down, it can be gapping up. But I would say this in the event that this movement, you believe that this movement is possible to come back down in this range, you want to be closing this position, this long put at a profit, and then also probably closing this. This is going to be totally worthless though. That's up to you whether or not you want to close this position. If price is down here, the odds of it reaching back up through the next 2 or 3 days if it gaps down is very unlikely. So that is the covered stock logic. If you have any questions, you can email me directly at peter@quantumedgeai, quantumedge-ai.com. It's in the description. And you can also comment, like, share, post. I would greatly appreciate it. Thank you.